All right, let's dive right into this explainer. Today, we're literally putting United Microelectronics Corp., better known as UMC, on trial. And we're not just looking at a bunch of random numbers. No, we're stepping right into the shoes of investing legends like Warren Buffett, Peter Lynch, and Benjamin Graham, and we're blending their timeless wisdom with some hardcore quantitative models. The ultimate goal? To figure out exactly what this semiconductor giant is actually worth.
Here's our roadmap for today. We've got 6 parts: the company snapshot, the Buffett lens, the Lynch lens, the Graham lens, a trip to the quant lab, and finally, our synthesis and final verdict.
Let's kick things off with Section 1, Company Snapshot.
We are anchoring our whole analysis in hard data right from the jump. Take a look at Q1 2026. UMC pulled in roughly 61 billion new Taiwan dollars in operating revenue. To put that into perspective, that's about 1.91 billion US dollars. But what's even more impressive? They delivered an earnings per share or EPS of 1.29 NTD, which translates to a US equivalent of 20 cents a share. That decisively beat consensus estimates of 12 cents. Seriously, they are generating a massive amount of capital.
Zooming out for a broader look, UMC is trading right around $21.40. And check out this balance sheet. They boast an incredibly strong cash position of 109 billion NTD. That easily, and I mean easily, covers their total liabilities of 193 billion. Plus, their overall wafer utilization rate ticked up to 79%, driven heavily by strong growth in the consumer segment. This is what you call a rock-solid foundation.
Moving right along to Section 2, the Buffett lens.
So, when we're talking Warren Buffett, evaluating the economic moat is absolutely crucial. Since UMC is a pure-play foundry, their moat is firmly planted in specialty technologies. The data specifically highlights soaring demand. We're talking record highs for their 22-nanometer logic and specialty processes. From a pure numbers standpoint, if we annualize their Q1 net income against their equity, we're looking at a return on equity of about 15.9%. And their debt? Like we saw, that 109 billion in cash easily swallows their 47 billion in long-term credit. You know Buffett loves a balance sheet that lets you sleep soundly at night.
Now, to find Buffett's true intrinsic value, we have to look at owner earnings. Since we're missing some of the long-term historical data in these Q1 results, we've got to explicitly calculate an approximate owner earnings figure. We do this by factoring in their stated 1.5 billion USD capital expenditure plan for 2026. Subtracting this heavy maintenance and growth CapEx from their cash from operations gives us the real picture. It shows us the actual cash they can distribute to us, the owners, or safely reinvest in the business.
But here is the million-dollar question. Even with these consistent earnings and honest management, does that $21.40 price tag offer the steep discount Buffett always demands? Well, given the massive ongoing capital expenditures required just to compete in the semiconductor foundry space, Buffett might actually view this current price as fair. But it probably lacks that massive 30 to 40% margin of safety he usually insists on before pulling the trigger on a brand new position.
All right, let's switch gears. Section 3, the Lynch lens.
Peter Lynch famously relies on the PEG ratio. It's elegantly simple, really. You just take the price-to-earnings ratio and divide it by the projected earnings growth rate. A PEG of exactly 1 is considered fair value. Anything below 1, that's your potential bargain. So let's run the numbers for UMC. Management is projecting high-teen percentage growth for their 22-nanometer logic in the second half of 2026. If we assume a blended overall earnings growth rate of around 15% and apply that to their current PE, the math spits out a PEG ratio of roughly 1.75. Since that's well above Lynch's magical 1.0 threshold, it tells us the current price already has a fair amount of that future growth baked right into it.
But under Lynch's framework, UMC actually fits the classic profile of a cyclical stalwart. They've got a fortress balance sheet and arguably way less institutional hype compared to their giant rival TSMC. So a Lynch-style investor would probably view UMC as a solid hold right now. They'd likely just wait for a cyclical dip to aggressively scoop up shares closer to that 1.0 PEG ratio. Let's bring in the ultimate conservative stress test. Section 4, the Graham lens.
We ran UMC through Benjamin Graham's defensive investor checklist, point by point. Adequate size, over 1.9 billion in quarterly revenue, pass. Strong finances, current assets totally dwarf current liabilities, pass. Earnings stability, yep, positive earnings consistently demonstrated. Moderate PE and PB, compared to the broader tech sector, they sit very comfortably in the value range. Honestly, it's pretty surprising. But this mature foundry passes Graham's strict criteria with flying colors.
Let's actually show our work for Graham's intrinsic value formula. We take their total equity of 406.736 million NTD, divided by outstanding shares, and we get a book value per share of roughly 32.56 NTD. When you crunch those numbers and convert them over to USD, Graham's formula suggests a floor value that closely trails their current market price. This indicates it's a very safe, albeit slow-moving asset play.
Now it's time to get a little nerdy. Section 5, the Quant Lab.
We are building a base case discounted cash flow, or DCF model. The process is straightforward. We forecast their future free cash flows, calculate a terminal value for the company into perpetuity, and then discount all of that back to today's dollars. Because semiconductor industry figures can swing wildly based on where we are in the cycle, we're explicitly assuming a standard 8 to 10% weighted average cost of capital, our WACC, and a very conservative 2.5% perpetual terminal growth rate. Now, this is where it gets really interesting. Notice how the fair value drastically shifts if we just slightly tweak our discount rates or terminal growth assumptions. If we use an 8% WACC and 3% growth, UMC looks vastly undervalued. But if inflation stays sticky and we have to push that WACC up to 10% with only 2% terminal growth, well, suddenly that $21.40 price tag looks perfectly priced, maybe even a little overvalued.
By bringing in alternative models, like pitting industry multiples against a reverse DCF, or looking at enterprise value relative to cash earnings, we can establish a much tighter fair value range. A reverse DCF basically tells us exactly what growth rate the market is currently pricing into the stock. Right now, at 21.40, the market is pricing in pretty modest single-digit free cash flow growth. Meaning, if you believe their 12-nanometer initiatives are going to accelerate growth beyond that, the stock is currently mispriced in your favor.
All right, we've gathered the data. Section 6, synthesis and final verdict.
When we synthesize all these legendary frameworks into one master table, we get a really clear picture of fair value alignment. Graham sees a deeply safe asset with a floor near $18. Buffett sees a wonderful company, but he might wait for a pullback to $19 for his required margin of safety. Lynch sees a fairly priced stalwart at $21, and our base DCF puts the fair value right in the $22 to $24 range. But hey, the numbers are only half the story, right? We have to weigh these calculated risks against UMC's aggressive strategy. Get this, a massive 90% allocation of their $1.5 billion capex is going straight into 12-inch wafers. Plus, their upcoming 12-nanometer collaboration with Intel, which is slated for 2027 production, is a huge deal. It provides a US-based manufacturing option that could fundamentally shift their geopolitical risk profile and open up massive new revenue streams.
So based on all our blended insights, here are the exact triggers for UMC at its current 21.40 level. It is a resounding hold for value purists like Buffett and Graham, who simply demand wider margins of safety. However, if you're a long-term compounder looking at that Intel partnership and their 22-nanometer momentum, it triggers a cautious buy. You get to leverage their fortress balance sheet as downside protection while you wait for those massive 2027 catalysts.
I'll leave you with this provocative thought to consider before you make your next portfolio move. In a world utterly obsessed with bleeding-edge AI chips, is the broader market fundamentally mispricing the quiet, inevitable cash-generating power of mature node foundries like UMC that actually run the everyday Internet of Things? I'll let the data guide your answer. Thanks for tuning into this explainer.